You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. Well, it's all over the headlines. Record gas prices. I read that in Washington State, I believe, they're running out of gas and they are preparing to add another digit to the per gallon price, which means they're expecting gas to go over $10 a gallon, something I've been expecting for years. You might have been caught by surprise, but look, we're investors and we're people. You have a family. How do you prepare for this? How do you profit from it? Because better to profit from it than to pay for it through the nose. And on that note, we got somebody I've wanted to have on the show for a long time. James West, you are the proprietor of the Midas Letter. And I've been reading your work for well over a decade. It's great to have you on the show. Hey, you mentioned you're just in the process of writing an article about this very topic. And it's not just energy costs, it's all commodities. There are going to be scarcity, shortages, in large measure due to policies governments have been pursuing for the past decade. And what's your take on it, James?
Hey, Kerry. Well, first of all, thanks a lot for inviting me on today. I really appreciate the opportunity. I, too, have been reading your work for years, so it surprises me that it's taken this long for us to meet. Yeah, you're right. I am in the midst of an article this morning, and it is oriented towards the price of gold. First of all, it's important to me that people understand, especially subscribers of my work, understand that the inflation that we are seeing right now, inflation is not a natural phenomenon. It doesn't occur by natural means. Inflation is the direct outcome of the abusive policies of central banks, and that has been the case throughout history. When central banks print money with abandon and on an unbridled basis, it basically causes such an excessive liquidity in the world. Whereas the growth of assets, which that liquidity can purchase, does not grow at that rate. That's when you get what they call inflation. There's just too much liquidity. You start to get competing bids for the limited supply of the things that matter. And that is what is happening now. So it's like, to me, this is just the outcome of the last 10, 15, 12 years since 2008 that they've been printing. I think the total is like $30 trillion worth of capital across the developed G7, G8.
Yeah. And hey, I find myself channeling the late, great Milton Friedman, Nobel laureate for economics, who said that inflation is first and foremost a monetary phenomena. And we've really seen that in the past couple of years since the pandemic and the governmental reaction to it. But in reality, this has been going on in spades since post-World War II. World War II, obviously, wars are very inflationary, as we're seeing now. And really, every generation seems to need to learn about inflation, not through textbooks, not by reading Milton Friedman, but by going to the supermarket, by going to the gas station. When you are confronted with double-digit, sometimes triple-digit price increases, all of a sudden you learn about inflation. But the politicians, they all want to blame it on Putin, the Putin gas hike, or shortages, never mentioning the fact they've created these shortages through permitting process and all that. We're like destined to repeat history over and over again till some catastrophe comes where it's indelibly etched upon the collective consciousness.
Yeah, you bet. Well, I mean, every single currency throughout history has resulted in a hyperinflationary prelude to a revised new national currency in whatever currency that happens. So it's no different now. I mean, and that's really the end game for the governments hyperinflating the monetary supply in the currency that they're working on is to roll it all back, forgive all the debt, and essentially reset the entire financial system.
Hey, so you're kind of alluding to a global debt jubilee. And if you're suffering under a burden of large credit card bills, student loan debts, inflated mortgages, you're kind of in favor of it. But if you're but one person's liability in our global financial system is another person's asset. And so you can't get rid of one without getting rid of the other, can you?
Yeah, well, yes, that's that's one of the problems. And any sort of, sovereign debt jubilee is not going to include credit card debt and auto loan payments and mortgage payments. That's the reality of it. So, I mean, I laugh, but it's really quite it's abusive, is what it is.
Yeah. So the way out, I know you and I, independent thinker, has been thinking about this for years. What is the way out of this? Is it a commodity-based monetary system, whether it's gold, oil, whatever you come up with, seashells or stones in the Pacific? What is it?
Well, I think gold has demonstrated over the course of at least 5,000 years of recorded history that it is the monetary instrument of choice, proven and demonstrated through the fact that here it is 5,000 years later that it's still in use as a unit of trade in certain circles. So preserving your purchasing power with your store of wealth, whatever form that takes, by diverting some of that into gold as a way of preserving the value of your portfolio is sort of like a hedge 101 strategy. The government and the mainstream financial media take every opportunity to try to portray investment in gold as inefficient, as ineffective, because you have to pay to store it, and it has no yield. And those are really interesting sort of comments on gold. But in an inflationary environment where your monetary purchasing power is deteriorating, it's not about getting a yield or paying for storage. It's about preserving the value of the portfolio of wealth overall. So when we're seeing the effect of this on markets, we take the NASDAQ, for example, is down over 25% since the beginning of the year. So all of your assets that are NASDAQ stocks have decreased in value by 25%. What has gold done in that time frame? So gold since the beginning of the year is essentially up, I think, like 4.5%, even down here at just below 1,800, or was it above 18? Oh, it's back above 1,800. I'm just looking at the screen now. So, I mean, there's the example. Jerome Powell signaled to the world in October last year that they were going to raise rates aggressively and withdraw stimulus, pay down the balance sheet by retiring some of that debt. That was a signal that inflation was imminent. That's the point where you should have taken all of your profits from NASDAQ, which was still hammering at the all-time highs, and you should have put it in gold right there. And what would have happened? What would have been the result today? The overall value of your portfolio would be slightly up.
Yeah. Well, hindsight's 2020, but you could definitely see it coming. Now, at some point, the Fed is going to pivot here. I'm convinced. I don't know when it's going to be. They usually like an external event to be the cause of the pivot so that nobody has to take responsibility. Market crash, expanded Ukraine-Russian war. What do you think that precipitating event is going to be?
You mean where the Fed reverses course and lowers interest rates and starts printing money again?
Exactly.
Yeah, well, okay, so NASDAQ is now officially in bear market territory, over 25% down. S&P and Dow are both around 16, 17%, so they're not in bear market territory. When all three major industries are in bear market territory, that is technically when we are looking at recession straight in the eye. Now, with out of control fuel prices especially, and with inflation across the CPI, I mean, I think that we're going to see retracement in the GDP of certainly the United States, probably North America, and almost definitely across the whole G8. The convergent influences of the war in Ukraine, which has taken anywhere from, call it 25 to 40% of the global oil supply off the market, to the supply chain sort of vulnerabilities that have revealed themselves as a result of the pandemic, to the diminished purchasing power as a result of the abusive central bank overprinting of money. All of these things are just converging to, essentially create a perfect storm of chaos. And I think that, I think a recession is the political event that central bank managers and the financial mandarins of the global financial system wait for to say, oh, okay, sorry, we overshot. We would have liked to have dialed back stimulus. We would have liked to have, raised interest rates to offset inflation, but unfortunately we can't because we're in a recession. And that's the standard operating procedure for central banks.
Yeah, they like to pretend that it's like they've got all these dials on the control panel and they can just tweak them a little bit and everything's going to be fine. But you and I know from their past acts and past economic cycles that it just doesn't work that way.
No, that's right. That's, the mainstream media is sort of the third triptych in the stool that holds up the illusion that we're all supposed to operate under, that inflation is a product of some natural, organic financial sort of system event, when it's not. It's the actions of central bankers that create these monetary changes. So it's it's hard to intelligently criticize central bank policy without getting emotional about it when it is so misportrayed by central bank or by mainstream media rather. And we're all supposed to believe that. It's infuriating and it's insulting.
It really is. And the miracle of it all is we've got these governments that are expanding all over the globe, expanding their power. Yet, technology progress marches on in fits and starts. Maybe if they just got the heck out of the way, things would normalize. I mean, in the good old days, before you had unlimited money printing, you generally could only have one speculative bubble at a time. Now we've got half a dozen speculative bubbles all frothing forth at the same time. Perhaps they're going to pop at the same time. And then what are they going to do?
Don't just survive, thrive. The Financial Survival Network.
Goldterra Resource Corp is a gold exploration company that has assembled a highly prospective district-scale land position on the doorstep of the city of Yellowknife in Canada's Northwest Territories. Goldterra is currently focused on expanding and delineating gold resources at the company's Yellowknife City Gold Project with a goal of discovering over 5 million ounces. With ready access to infrastructure and multiple high-grade gold discoveries, Goldterra is on track to re-establishing Yellowknife as one of the premier gold mining districts in Canada. Goldterra trades as YGT in Toronto and YGTFF on the OTC. For more information, go to goldterracorp.com. That's goldterracorp.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, well, the problem is that the reduction in regulation, I mean, if you look at the whole crypto phenomenon, there are over 3,000 cryptocurrencies in various stages of capitalization. I mean, obviously, Bitcoin is the granddaddy of them all. And it is my conviction that the governments have sort of colluded to permit these new asset classes because they sop up so much of the excess liquidity being generated by these central bank policies. Now, the main reason for stimulus is not to prop up markets. It's to generate fees and profits and justify pay increases for everybody in the government sort of economic layer. And so they do this under the smokescreen of quantitative easing or stimulus, or as my father called it, creative counterfeiting. And it's really a case where you're creating liquidity based on a financial pool of assets. And when those assets start to, sort of the choices dry up, we used to have, commodities, real estate, stocks, bonds. That was it. Those were your choices to invest in. Now we've got all these synthetic assets, which include cryptocurrencies. You have securitized debt in 50 different flavors. You've got options and puts. You've got collateralized debt obligations. You've got betting on the insurance that covers these things against default. I mean, there's all of these synthetic asset classes have been permitted, even though, as Warren Buffett has said, they're financial instruments of mass destruction. Yet they're permitted because they sop up so much of that excess liquidity. And that is what has offset the actual establishment of rampant inflation over the last 10 years while this printing is going on, is the allowance of these new asset classes to consume all of this excess liquidity. Now that has happened. Cryptocurrencies have reached a sort of a height of investment. All of the people who are interested in investing in cryptocurrencies have now invested. There are no more people. And fundamentally, people are the essence, the basis of all demand. So that's topped out. And that's what we're seeing here. So that's why they have to halt printing of money, because there's just nothing more to buy. There's no other asset classes to absorb this excess liquidity. Everything is saturated. And so what happens is the big capital pools in the world that have been the beneficiaries of this easy monetary policy are now going to extract their cash from all of these assets. So what we're seeing is now an excessive assets for sale, while the liquidity that has driven markets higher, the Fed is withdrawing the liquidity that supplies all of these large capital pools. They're leveraged to purchase these things. So they, in turn, they give up the assets and pull out the liquidity. And so we're seeing the cash liquidity position go sky high. Credit is collapsing and interest rates amid rising interest rates. And the markets are getting flooded with assets now that people realize that they don't want. They'd rather have cash. So it's a perfect storm. I mean, really, this is essentially the resumption of the financial collapse that began in 2008. That was only offset temporarily, and when I say temporarily, I mean for the last decade, by quantitative easing.
And that's a great point. So we were in the eye of the storm for like 12 or 13 years, and now the eye has passed, and now we're reaping what we sowed from so long ago, really from a century of economic mismanagement and profligacy by government. And government just exists to justify itself and take ever more a larger slice of the overall economic pie. But we're hitting that tipping point where the can can't be kicked down the road any longer, and you've got to do things now in anticipation of that. So gold, commodities, what else should you be doing?
Well, I think in this environment, there's really only a few things that any individual can do. I mean, so in 2019, I bought a farm in anticipation of this, what has to be a deflationary event and a collapse in commodity and asset prices. I bought a farm, and I bought a farm because I want to be in a position to grow my own food and not be reliant on the global food distribution system for survival. And I made a point of paying cash for the farm, and I have no mortgage. I have no debt. So strategy number one is free yourself from any bank-oriented debt, because really any debt is the noose around your neck that the bank at any time can pull tight and start to strangle you, especially if rates rise. I mean, obviously variable rate mortgages are a godsend in times where there's lowering interest rates. But in a rising interest rate environment, if you don't have a fixed rate mortgage, you are basically susceptible to what is going on with interest rates generally. So that's number one, is make sure you don't have your home encumbered by debt, thereby risking your place to live. The second thing is, how do you protect your pool of wealth, that your nest egg, your operating capital? Well, I think, an investment in gold is not so much an investment in a rising asset class, a speculative investment is expected to return a profit, so much as it is a movement of your wealth from something that becomes more volatile in times of inflationary market corrections and putting it into something that has more stability. If you look at the chart for gold since 2008, which is behind me here, I mean, you can basically draw a straight line from 2002 to where it is today, and it's basically risen by 600%. In that time frame, the volumetric increase in the monetary pool has occurred at a factor of 10 to 15 times the available. Since 2010, I just was doing this research that they've produced 37,500 metric tons of gold globally everywhere. Mm-hmm. In that same time frame, the global liquidity pool has gone from an estimated $5.8 trillion US equivalent to over 30 trillion US equivalent. Now, 1/3 of the US dollars in circulation have been printed since 2020. So it's just mathematically impossible for prices not to reflect that excessive growth in liquidity in the prices of what we eat every day. It has to happen. So, investing in gold is a way to preserve that purchasing power. Obviously, you can't spend gold at the grocery store, but you can convert gold into cash incrementally as you need it. And therefore, you're not subject to this volatility that we're seeing in market corrections.
All right. I like that. But, gold is, I don't know if you subscribe to the suppression argument that the central banks have been suppressing gold, particularly the Fed, for decades now, going back to the London gold pool, probably before that. At some point, gold's going to find its own level, isn't it?
The price of gold does not reflect the value of gold in today's current market context. And that is a result of the structural defective nature of the futures market. Now, in the futures market, any capital pool, any investment entity can write a call on gold for 1 month, 2 months, 3 months, 6 months out, far in excess of the amount of gold that's going to be produced by miners in that time frame. In fact, the futures market constitutes the physical gold market by anywhere from a factor of 10 to 100, depending on the day of the week. So structurally, the futures market, which was originally created as a price discovery mechanism for banks that wanted to lend farmers enough money to get the seed and equipment they needed to deliver a crop to the market, so to repay the bank, that's what the futures market was for. Now, futures has become a price leading mechanism where investors look at the futures price and say, oh, that's what the price of gold should be worth today. And they base their decisions on that, and they base their perception of the value of commodities on that. And so what we have today is this perception that the price of gold is $1,980, $2,000, when the value of gold relative to the printing, the volumetric printing of money that has happened in a relative time frame is far greater. So the value of gold is actually much greater than the price of gold. And that is something that's very difficult for people to wrap their heads around. And that's what makes gold such a screaming buy right now. And that's just impossible to convey to anybody who buys the sort of the zeitgeist of the day, the public discourse where, oh yeah, central banks are doing their best to maintain employment and the stability of purchasing power. They're doing the opposite while broadcasting that they're trying to act in the interests of the common man. They are not. And the suppression is subtly committed through the structural defectiveness of the futures market.
Right. Right. And we see that all the time. Gold will be really catching a bid, ready to break a crucial resistance level, and then boom, a zillion contracts get released onto the market and the price is slammed. And it's the same with silver too, even to a greater extent. Well, that's the problem. It's going to end at some point. James, it's been great having you on the show. Just tell us, how do we connect with you? How do we find out more about the Midas letter, and where do we go from here?
Well, MidasLetter.com is where I've lived online since 2008. And we do our show every Thursday. It actually gets published on Friday now on YouTube, YouTube/Midas Letter. Kerry, I really appreciate the opportunity. I'm going to reciprocate in due course here.
Promise? Okay.
You bet.
I can't wait to be on your show. James is somebody, thought leader in this space, who I've followed for over a decade. It's great to finally connect with you. If you've got a question for James, you can always shoot me an email, kl@kerrylutz.com. We'll get you an answer. And don't forget to sign up for your free newsletter at financialsurvivalnetwork.com. James, a pleasure. We will definitely be talking to you again soon.
Sounds good, Kerry. Thanks for the time.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.